As the world winds down after Christmas, with festive lights still glowing and shoppers making their way through decorated city streets, a very different kind of energy pulses through the financial world. Financial markets are anything but quiet. While many are still enjoying the holiday break, traders and analysts are glued to their screens, watching history unfold in real time. Today, December 26, 2025, gold, silver, and platinum have all smashed previous records, sending shockwaves through the global economy. The surge is dominating headlines, with experts scrambling to explain the dramatic moves and investors reacting to every tick. Silver leads the charge, soaring 7% in a single day to a record $77.12 per ounce, a staggering 167% gain this year. This meteoric rise has left even seasoned market veterans astonished, as silver's rally outpaces nearly every other asset class. Gold isn't far behind, hitting $4,533 coin per ounce, its best annual performance since 1979. The precious metal's reputation as a safe haven is being reinforced, drawing in both institutional and retail investors seeking shelter from economic uncertainty. Platinum joins the rally, surging 8.7% to $2,148.25 per ounce, fueled by both investment demand and industrial supply concerns. The metal's unique role in manufacturing and green technologies is adding to the buying frenzy. Even metals like palladium and copper are rallying, signaling broad-based strength across commodities. This synchronized surge suggests deeper shifts in global supply chains and investor sentiment. Investors are flocking to hard assets, questioning traditional financial assets and seeking security in precious metals. The rush is being driven by inflation fears, geopolitical tensions, and a growing distrust in fiat currencies. This year-end rally is a clear signal. Economic anxieties and shifting strategies are propelling metals to center stage. As 2025 draws to a close, all eyes are on the precious metals markets, wondering just how high these prices can go and what it means for the year ahead. The surge in precious metals is the result of a perfect storm of factors, each amplifying the other to create a dramatic rally in prices. Gold, silver, and platinum are all seeing unprecedented demand, and the reasons go far beyond simple supply and demand. The U.S. Federal Reserve is expected to cut rates in 2026, making non-yielding assets like gold and silver more attractive. When interest rates fall, the opportunity cost of holding metals drops, so investors flock to them as a store of value. This anticipation alone is enough to send ripples through global markets. Speculation about a dovish Fed chair under President Trump adds to expectations of prolonged low rates. If the next administration favors looser monetary policy, it could keep borrowing costs low for years, further fueling the metals rally. Political uncertainty is making investors hedge their bets. The U.S. dollar is weakening, making metals cheaper for international buyers and boosting global demand. As the dollar loses strength, investors around the world look for safer alternatives, and precious metals become even more appealing. This currency shift is a major driver behind the current surge. De-dollarization by central banks is pushing more investment into tangible assets like gold. Countries are diversifying their reserves, moving away from the dollar and into metals to protect against currency risk and geopolitical instability. This trend is accelerating as global trust in the dollar wanes. Geopolitical tensions, U.S. airstrikes in Nigeria, oil blockades in Venezuela, are driving investors to safe havens. In times of conflict and uncertainty, metals are seen as a reliable store of value. These flashpoints are making markets nervous, and that anxiety is reflected in soaring metal prices. Supply constraints are tightening markets. Deficits in silver, central bank gold buying, and industrial platinum demand are all squeezing availability. Mining output is struggling to keep up, while new technologies and green energy are increasing industrial demand for metals like silver and platinum. The result is a self-reinforcing cycle of rising prices, as monetary policy, currency weakness, and global uncertainty converge. Each factor feeds into the next, creating momentum that's hard to stop. Investors see the rally and jump in, pushing prices even higher. Investors are responding to a world in flux by piling into metals. From individual traders to massive institutions, everyone is seeking safety and growth in precious metals. The rush is global, and it's changing the landscape of financial markets. The rally is both a symptom and a signal of deeper economic shifts. As the world navigates uncertainty, metals are becoming the asset of choice, reflecting not just fear, but a fundamental change in how investors view risk and opportunity. Silver is 2025's breakout star, surging past $77 per ounce. Its new status as a U.S. critical mineral has drawn massive investment thanks to its role in defense and green energy. Years of supply deficits have left the market tight, with demand from solar, EVs, and 5G accelerating. Retail investors, priced out of gold, are flocking to silver as an accessible alternative. Silver's dual identity, industrial and monetary, makes it uniquely appealing. As prices broke key barriers, trend-following funds and short squeezes fueled the rally. The fear of scarcity is driving both industrial users and investors to secure supply. Silver's explosive rally is the result of fundamental shortages, technological demand, and market momentum. Gold's record high above $4,500 per ounce cements its status as the ultimate safe haven. Central banks, especially in China, Russia, and India, are buying gold to diversify away from the US dollar. This de-dollarization trend provides a stable base of demand, supporting higher prices. Lower expected interest rates make gold more attractive compared to low-yielding bonds. Geopolitical flare-ups, Nigeria, Venezuela, Ukraine, are fueling safe haven buying. Gold stands apart from currencies and stocks, offering protection from political and economic turmoil. Institutional investors are increasing allocations to gold as financial insurance. In uncertain times, gold's appeal as a store of value only grows. The yellow metals rally is a direct response to global instability and shifting monetary policy. Gold remains the world's trusted refuge in turbulent times. Platinum has surged to a record $2,148.25 per ounce, propelled by both scarcity and future promise. Supply disruptions in South Africa and Russia have squeezed the market, while demand is shifting toward green hydrogen technology. Platinum is essential for electrolyzers and fuel cells, making it a key player in the clean energy transition. Investors now see platinum as both an industrial necessity and a hard asset hedge. Its rarity, 30 times scarcer than gold, adds to its allure. The rally is fueled by supply constraints, new technology demand, and a search for undervalued alternatives. Platinum's ascent marks its arrival as a critical metal for the 21st century. To make sense of the recent wild swings in the metals markets, we turn to Peter Grant, senior metals strategist at Zaner Metals. With decades of experience tracking precious metals, Grant is known for his deep insights into what drives these dramatic price moves and how investors can navigate them. Grant highlights several key factors behind the current volatility. He points to shifting expectations around Federal Reserve policy, a persistently weak dollar, and ongoing geopolitical tensions as the main forces shaking up the markets. Each of these elements can spark sudden reactions, sending prices sharply higher or lower in a matter of hours. During the holiday season, trading volumes are often thin, which means there are fewer buyers and sellers in the market. This lack of liquidity amplifies price swings, so even relatively modest buy-or-sell orders can have an outsized impact, causing prices to jump or drop quickly. As metals break through important resistance levels, automated trading systems and trend-following investors quickly jump in. Their rapid-fire trades add fuel to the momentum, accelerating price moves and sometimes creating a feedback loop that pushes prices even higher. Looking ahead, Grant sees gold targeting $4,986.81 in the near term, a level that could be reached if current trends persist. He believes that if the bullish momentum continues, gold could even reach the symbolic $5,000 mark as early as 2026, driven by strong investor demand and macroeconomic uncertainty. For silver, Grant identifies $80 as the next major hurdle. If silver can break through this resistance, he suggests that the metal could see even larger gains, as more investors and traders are drawn in by the breakout and the potential for further upside. Underpinning this rally are severe supply deficits in both gold and silver markets, combined with robust investment demand. These fundamental factors are creating a powerful tailwind, making the current uptrend more sustainable than many previous rallies. However, Grant cautions that the road higher won't be smooth. He warns that profit-taking and short-term pullbacks are likely, as some investors lock in gains after sharp rallies. Still, he remains confident that the overall uptrend is strong and intact. His message is clear. While volatility is here to stay, the fundamental drivers for higher gold and silver prices remain robust. Investors should be prepared for turbulence, but the long-term outlook continues to favor those who stay the course. Record prices are hitting physical markets in Asia hard. In India, gold's cultural importance clashes with sticker shock. Retail buying has slowed, and jewelers are offering steep discounts. High prices are forcing families to postpone purchases or buy less, highlighting the tension between investor gains and consumer demand. In China, gold traded at a discount as demand faltered, but those discounts are narrowing as buyers adjust. Speculation is rampant in silver, with regulators stepping in to cool the frenzy and limit new fund subscriptions. Authorities worry about a bubble, aiming to protect retail investors from sharp corrections. The East's traditional demand pillars are straining under the weight of Western-driven price surges. As 2025 ends, all eyes are on 2026 and whether the rally can continue. Anticipated Fed rate cuts and a weaker dollar should keep gold and silver attractive. Analysts see gold's next targets at $4,686 and even $5,000, driven by central bank buying and geopolitical uncertainty. Silver's volatility could push it to $80 or even $100 if supply deficits and green energy demand persist. Platinum's outlook is tied to its role in the hydrogen economy and ongoing supply issues. The consensus, the upward trend, is likely to continue, with new record highs possible. The path won't be smooth, but the drivers remain strong. Precious metals are set to remain in the spotlight as the world navigates economic and political uncertainty. For investors, the precious metals surge offers both opportunity and risk. Metals can hedge against inflation and currency weakness and are central to future technologies. Silver and platinum, in particular, are tied to the green energy revolution and electronics. But after such a rapid rally, the risk of a sharp correction is real. Profit-taking or a shift in Fed policy could trigger a sell-off. High prices may also dampen demand, as seen in India. The key is a long-term perspective and caution against chasing the rally. Dollar-cost averaging or waiting for dips may be prudent. The story of 2025's metals boom is still unfolding, with both rewards and challenges ahead.